Hello and welcome to the Weekend Investing Daily Bite of 25th of October. And there was blood on the street. The way you read in the investment thesis books, buy when the blood is there on the street. There's a lot of blood on the street. Nobody's buying right now, and that is why the blood is there on the street. So while the market is getting bloody, one needs to, have realistic sort of approach, realistic expectations. I think if anybody is getting nervous or fearful, that emotion should go away because this is natural for the market to do, especially what it has done in the last many years. Even another 10% from here is really not out of the syllabus. So from that perspective, while we have significant cuts in some parts of the market, overall, I don't think there has been such a big mayhem like people have been talking, at least on X and other interactions. So while it is easy for us to have recency bias, that's the sort of human behavior that we are susceptible to. Markets kept going up, up, up every month, every quarter, and we tend to assume that that is normal life in the market, but that isn't. So just like any other activity where there are periodic ups and downs, backs and forth, or even like in a movie, some portions will get climactic and some will get boring. So this, I think we are now entering a consolidation boring period of the market, and that is something that one would should have expected at some point of time. uh, there is I would say, in terms of distance from 200 DMA, and I'll show you that on the charts, is not so much. So if even if we assume for now that markets are going towards the 200 DMA, it's not so bad when you look at that. The fund flow, of course, is the reason why we are still holding here. Otherwise, we could have been 20% lower, the domestic fund flow, and the FII fund flow, of course, continues to uh, be in the red. Bears in complete control. That is the topic for discussion today. Should you panic? Um, Disclaimer, and do subscribe to the channel as well. So markets have come down to, I would think, a reasonable support level in the, at least in the short term. If you recall this head and shoulders pattern that we were talking about, which broke down near this 24,800 mark, has given up almost 600 points. We were talking about a 1,300 odd point or 1,400 point head. So another 600-700 points is where we could go to. So 23 to 300, 2,400 is a logical uh, final destination for this pattern move. But this leg right now in the last 7-8 sessions has given up reasonable ground. So there may be some bounce, and then there may be, if we have to really break this 24,000 band also, then we will go towards 23, 300, 400. Uh, Results of many companies, whether in banking, you have seen how banking results have been muted or really bad in terms of second run banks. Microfinance is really bad. uh, Auto two-wheelers are struggling. Paint companies, FMCG, are not finding volume growth. So there seems to be struggling growth all around, while the picture that was getting painted so far was that nothing is uh, a major issue and things are chugging along. So maybe the tax revenues have been growing much faster than the industry growth and the top line growth, and that is now coming back home to give some pain to the markets. Also, this all started when the money started to move towards Japan and China beginning of October, and October somehow is that month which is rarely, a fantastic month. The biggest disasters in the markets have happened in October, and I'm just hoping that the next 3 or 4 sessions that we have in October, ending into Deepavali, we don't have any such disaster. So if we do stabilize here, somewhere around here for the next 3 4 days, I think that's markets will take it with folded hands. Nifty Next 50 index has broken below the election day high and the recent supports. It is now precariously poised below 70,000. It has also lost significant 7-8,000 points in the matter of last week, and today also 1.57% was lost here. Mid cap index also reeling under this pressure after 2 days of catching up after this fall. The downtrend has started again, so it's a continuation of this trend, not yet ended, but we are in this some sort of a sweet spot support zone here. Hopefully, we get some support here, minus 1.7% on mid caps. And the same runs for the small cap, which lost 2.28% today. Somewhere near this support zone is there. We have sort of retraced four for maximum like 4.5 months of gains. So if you were to transport yourself back to June, we are somewhere there near June. So nothing, gigantic has been lost, at least not as of now. Um, this whole thesis that, we have achieved X on our portfolio, so X minus 5% is really bad. That we really need to get out of our heads. If you started at 100 and you are now at 200 and now you are now at 175 after a drawdown, you are still, significantly higher from where you started. And of course, there will be points where, people will start at the absolute top. And I've shown enough studies that even if you start at the absolute top and over the years, if you gradually bring in the money, there is absolutely no reason why you will not make a lot of money. But stop evaluating your portfolio in like 3 months, 6 months when you've had like the tweet I did this morning that people invest with the view of 2047, but then watch the price at 9:15 a.m. and they start to panic. So that is something that requires maturity in investing. And after a few cycles of experiencing the markets, you will realize that there is no point of, you know, wrecking your brains over, these corrections and so on and so forth. This is just part and parcel of the market life. Don't get perturbed because of this. Don't disturb your life because of this, because market should not be your life. Markets are just one medium that you are using to grow your money. And you know that over a period of time, if your strategy is working well, whatever may be the market, you will see the other side with good returns. That confidence and ability to withstand the volatility is why the market is giving you returns. Otherwise, you would have got bank returns, right? Because you have the ability to withstand this volatility. That is why the market will present you with additional returns, and that's what you have to strive for. Nifty Bank also coming off. Nifty Bank is now completing a head and shoulders pattern, and if that were to give away, then we are looking at significantly lower levels. Nifty Bank currently is where the election day high was. So Nifty Bank, I think, is reasonably stable here. It's not really cracking very hard. And with these kind of corporate numbers and low growth, maybe the RBI will be prompted to look for some rate cuts, and that may help Bank Nifty going forward. 1.4% on Bank Nifty there. Advanced decline ratio totally in favor of declines, 426 declines versus 74 advances, so completely demolished advances. 5,000 crores of selling again by FIIs, DII buying somewhat slowing down, 3,600 crores. And as I mentioned a couple of sessions ago, this confidence that local money will continue to pour in can vanish very, very quickly. So, 15 days, 1 month of real, stress in the market, and a lot of folks will start to stop SIPs or withdraw their money or, do things of that kind. I was so surprised to hear that the average fund investor is there in the market only for 1.5 years. That is the average from MFI. I mean, if you come into the market only for 1.5 years, either you get very lucky to get your timing right, which is very unlikely that many people will do that, or basically you come into the market and you see the market fall and you go away. or you come into the market and you find the market is consolidating for the next 2 years, nothing happens, and you get bored and you go away. So these are all the reasons why most people don't really make what they should be making from the market, is not spending enough time in the market and then not keeping confidence to ride all the market cycle. Axis Bank and ITC along with Sun Pharma gave some support to the Nifty, but other than that, most stocks on Nifty were in the red. Reliance, State Bank, Bajaj Finance, Maruti, Mahindra, all were under selling pressure. Nifty Next 50 was devastated with DLF, IRFC, PFC, REC, ICICI Pru, Adani Green, all of them losing 3%. Indigo, IOC, Vedanta, all these good stocks, Adani and Sol, all losing more than 3%. Canara Bank, and only Lodha, Torrent Pharma, Pidilite, Godrej CP making some gains in this uh, red mayhem. Sectoral trends all red except FMCG. FMCG also is just a dead cat bounce after yesterday's thrashing. So you can say that there was really no sector that was looking up. Yes, IT and pharma being defensives were not crashing down like others, but real estate, infra, auto, energy, commodities, PSU banks, metals, public sector enterprise stocks, all were getting thrashed quite badly. In the last 1 month now, we've lost 13.8% on real estate, 10% on public sector enterprise stocks, 11% on autos and energy, 10.3% on consumption, and 10% on FMCG also. Not too many places to hide, uh, but that's how the markets are right now. A small blip in the FMCG index today in the green, and these were some of the stocks doing a bounce there. Spotlight is on Thermax. So Thermax is bucking the trend in the market, and after a consolidation since June, is now looking to uh, have this inverse head and shoulders pattern, looking very, very strong. Given that the market is in a weak situation, to have a stock go up actually tells you that it is in a strong uptrend going forward. So bears seem to be in complete control right now. Should you panic? Of course not. You should not be panicking at all. So let's study the progression of percentage of stocks above multiple moving averages in various benchmark indices to get a feel of how things are doing. So before 1st October, you had almost 94% stocks were above the 200 DMA. I've taken the simple moving average, and 72% stocks were above even the 20-day moving average. So this was really, strong moves, or at least no down move before 1st of October. And then you can see how quickly we have gone from nearly 98% stocks above 200 DMA to 60%. So almost 40% stocks are now below the 200 DMA. Almost 65% stocks are below 100 DMA. Almost 90% stocks are below the 10 DMA. So in the very, very short term, I mean, stocks have really collapsed in the Nifty 50 group as well, right? Now, some of the top gainers still for this calendar year, Sun Pharma is still up 47%, ICICI Bank is still up 25%. So there are winners within the Nifty pack, but there are some sore losers also, where Nestle, the behemoth of FMCG, has lost 17% this year. Kotak Bank is down 7%, HUL is down 5% this year. So while from the 52-week high, the falls may have been much more, but from a calendar year perspective, there has not been so much of a fall in the large cap space. If we see the Nifty junior space, again, 86% stocks were above 200 DMA beginning of October, and right now we are standing at midway at 50%. So significant number of stocks have gone below the 200 DMA, and of course the 100 DMA, 50 DMA, and 20 DMA have collapsed also in a big way. 20 DMA is only 2% stocks are above, uh, and even the 50 DMA is, or SMA, you can say, is 2%. So everything is looking down, which is also sort of, maybe a condition of being very short term oversold, where some bounces can happen. Within the Nifty Next 50, you have Zomato, which is still 103% up in this calendar year. Torrent Pharma and Divi's Lab are nearly 49 and 48% up. The bottom three within Nifty Next 50 right now is Macrotech developers, Godrej Consumer and Pidilite, which are still in positive territory. So again, in Nifty Next 50, just like Nifty, the worst three are also not so bad in terms of how they have performed in the calendar year. In the next segment of mid cap 150, again, you're finding the 200 DMA was rolling at around 87% of the stocks, and now we are down to 54%. So it is almost an even kind of a move between mid caps and what we saw in large caps. 10% of the stocks are above 20 DMA, 16% are above 50 DMA. So most of the stocks are looking down in the very, very short term. Here you have Oracle ruling at plus 150%, Thermax at 74%, CG Power at 64% still in the top three. And the bottom three here are Tata Elxsi minus 20%, Grindwell Norton minus 9%, and Astra Polytech minus 6%. Again, here, I mean, 20% yes, but not really. It's not like a complete bloodshed that has happened in calendar so far. In the small cap space, of course, there is more chaos. For instance, the SMA 20, only 10% stocks are now above the 20-day moving average, and only 47% stocks are above the 50-day moving average. So here also the slide has been similar, but the bottom three here are Birla, JNK Bank, and Cyient, all nearly 20+% down, while Aegis Logistic is up 112%, First Source is up 80%, and PTC is up 74%. So within each segment, there were several pockets which were still performing or still are reasonably performing, and there are pockets which are doing not so well within that segment. So the idea ideally should be to stay with the stronger part of the segment and get out of the weaker part of that segment. The biggest mistake one is making is not sticking to strategy for sure. Significant number of folks are buying stocks because of an investment thesis, but are selling stock because of a pricing issue. When you're buying because you thought, and I'm not necessarily talking just about momentum here. You're buying because you like the company, you like the earnings, you liked the promoter, you like the industry or the prospects of the industry. But then when you see the price at 915, you get weak knees and you chicken out of that. So be sure why you are buying the stock, and for the same reason you should be selling the stock. If you are buying the stock based on price, then let price decide when to exit. If you're buying a stock based on certain investment thesis, then let that thesis play out or get nullified. Then you get out of the stock. But having a buy signal based on something and sell signal based on a completely different kind of a metric probably will not help. Also, you have to see from a point of view of a larger picture point of view. We have been going up since pretty much, I would say, mid of 2022. This is where the bottom was made at 15,250. And we had a leg up, then we had a correction, then we had a leg up, then we had a consolidation, and then we had just the leg up, right? So since last year, October, November, we have been going up. So this entire year basically has not seen much of time correction. At least there was correction during election, but there was not never a time correction. So a correction like this actually, a 2 3 4 month correction probably is very ideal. It'll reset back expectations. It will give time to stocks to come back to reasonable levels, and it will also temper expectations, that unrealistic expectations that some people start to have when each month is going up and up and up. So like stocks and indices will never grow to the skies. We need to know that, and from time to time we will have these corrections. So absolutely nothing should be done in terms of reacting to these. If your money is a short term money, if you need this money in the next 6 months, 1 year, get out of the market, in my view. Don't speculate on that. If your money is a slightly longer term view, 2 years to 5 years kind of money is there, absolutely no reason to get out. Stay put and focus on investing more on each occasion where you find there is potential to be put the money in the market, and you need to leave the rest to the markets. Everything is not predictable. There is a lot of luck factor that is there in the markets. You need to follow some right strategies. Your strategy should be such where it corrects itself, even if it makes a mistake. And if you have that process in place, or if you're following a strategy that has that process in place, then really no need to worry. Keep the worry aside, focus on your professional goals, and allow the investment to take care of itself. You need to give time to certain things for them to give you the final result. Thank you so much. Do share this video with your friends and family, and I'll see you in the next one. Bye.